We're back with our guest co-host, Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management. We're talking about investors and what kind of confidence they should have about the current market, which is kind of defying everything, isn't it?
Yeah, defying gravity and other, other realms out there. I think we're talking about off camera, this extreme shifts from extreme negativity to at the beginning of the year in March and April with the tariffs to now extreme euphoria or the beginnings of that as everything's going to be okay forever, is just the yin and yang is so extreme. And I think that when the market gets its mindset on making a move, the rate at which we haven't had any breaks since that low in April is just remarkable.
And everybody just hops on, don't they?
Everyone hops on, and we're now, not quite through, but as we get through the month of October, which September and October are generally, periods of time where markets have had challenges before. If we're on the other side of that without any kind of break, there's going to be likely some kind of rush into the end of the year as people who have been waiting now pile in, and then that gets spent into the beginning of the year. So we're right at the cusp of what feels like could be another euphoric move higher, although that sentiment is already there. And again, at the same time, from our previous segment, the economy is slowing, but valuations are at all-time highs. And so the challenge with being too concerned about valuations is they won't matter for long periods of time. One of the ways that we like to look at valuations, just in an overall general sense, is what is the overall market capitalization in the U.S. relative to GDP? Yeah. And it's essentially, I think it's, it was the one that Warren Buffett used. They call it the Buffett indicator of what's your overall market cap to GDP, and that's your economic output relative to the market. It's at the highest level it's ever been. It's over 220%. So the economy has never been more dependent on the stock market for consumption. We have a significant amount of the population that is retired, living off of their assets, which feels great right now. The challenge is when you get to this extreme level of multiple earnings valuation, the risks are higher that things won't be as good as they actually are perceived to be right now at some point in the future. And that you've got the cocktail for lower interest rates. You've got the themes of AI, which are great right now. It won't last forever. I think investors need to be increasingly mindful of where we are in the environment, of what a top or topping or bubble top feels like, and we're kind of in what that feels like.
Were there any times before this that were close to being this high? I looked at some, and I think I saw 150%, maybe 175, but nothing.
Yeah, so there's
north of 200.
No, we're at the beginning of this year, or end of 2024. I think we just got up to 200%. Previous highs in that valuation metric, I think 1999 was about 150%, which would have been off the charts. I think there's a couple factors why this time's a little bit different, in that so much of global savings has piled into the U.S. stock market. And so where in the 1990s or previous highs in the late 60s, investors in Europe and Asia weren't all in on U.S. tech stocks like everyone is today. And so as the U.S. has absorbed all this capital, it's pushed up their valuation higher, which then you could expect the reading to be at a higher level. The challenge is it doesn't feel good when that number breaks, because it's going to really affect consumer spending sentiment, and we're at a very dangerous moment from that perspective. But again, doesn't mean it's ending today or tomorrow or next month, or we could keep going on for a long time. But we're in the neighborhood of things are extreme, and I think investors just need to be mindful of that and mindful of the risks that they're taking. And it's a time to be careful. It's not a time to sort of leave the party, but it's a time to be very careful. And it doesn't feel good sort of, leaving the party early.
Could this be a time where it's a reinventing of what's overvalued?
Yeah, well, I think...
Could it?
I think that what tends to happen in these periods of time is the definition of valuation changes, and the definition of multiples that people are willing to pay for companies changes. Because, again, as of right now, nothing will ever be bad again. Everything is great. Will that be the case? Possibly, but
I said that in
probably
1929 too, I think.
Yeah, you can go through, and the way in which human nature tends to recreate these cycles is pretty, it's pretty fascinating. But we're there. It doesn't mean it's ending now. But I think we're in the realm of people need to start being careful and mindful of the risks that they're taking, and it's not a time to be adding a lot of risk. That's sort of our main position.